So welcome. Thanks for coming. We are the M&A panel. So I will introduce you to our great panelists here. To my left, we have everyone. But first we have Muddu Sudhakar, who is an entrepreneur and executive and a board member of Baffle, which is a data protection company, and DB Cyber Technology, which is a data security manager. Next, we have Eric McAlpine, who's co-founder and managing partner at Momentum Cyber, which is an investment bank devoted to cybersecurity. Then we have Alex Dahl, founder and managing partner of 1011 Ventures, which was the first VC fund founded to focus exclusively on the digital security space. And last, we have Ken Schneider, vice president and head of ventures at Symantec Ventures, which is an investor in early-stage cybersecurity startups. So I just wanted to kick off by asking what makes a company in the cybersecurity space a desirable takeover candidate? Ken, do you want to jump in on that one?
Sure. Yeah, so look, I think the biggest impact that Symantec can do, I mean, we're the largest cybersecurity company by double of anybody else, and as our stock price has recovered in the last couple of days, we'll get back up to that 20 billion market cap people were talking about earlier. But what we really look for, honestly, we do different stage acquisitions, so there's probably no single answer. But for earlier stage acquisitions, it's really about, can we plug that company into the machine and rapidly accelerate the revenue of whatever that product that the company's got. And if we can do that, we've already proven that we'll pay top dollar essentially for companies with not all that much revenue if we feel like we can really scale the revenue quickly. Symantec's got literally thousands of feet on the street in the field. Like as we all know, most small companies don't have that. So the ability to kind of rapidly take a nascent technology product, plug it into a platform, and then drive a ton of sales around it, that's honestly one of the biggest things we're looking for.
What makes it easier to plug in a company like that into your
So in the past, this has been really hard. I mean, many of us have been on the side of acquired companies and acquirer, and integration is the way you're always measured. And so I think the thing that's gotten a lot easier in the last 5 years or so is security has been traditionally very poor at platforms and open APIs and the ability to tie things together quickly. So I think that's changed quite a bit. I think there's now platforms where you can actually do, honestly, our whole investment thesis is to drive more innovation around the ecosystem, work with companies that can plug things together with Symantec, get more innovation to our customers more quickly. So companies that do that make it much more easy to acquire and then easy to get that rapid success. I mean, you always model synergies, of course, in any M&A exercise. The upside synergies are dramatically higher if you can do some of those integrations prior to any actual acquisition.
Sure. Alex, any thoughts on this topic of what you...
Alex has been acquired by Symantec.
Yes, Ken bought me. Actually, in 2010, I was the chief operating officer at PGP. So 2002 to 2010, we were acquired by Symantec. And so know a thing or two about that, the two of us. I think in general on M&A, the thing that a lot of people think, it's our standalone valuation. I think the thing that gets missed the most is, and I sort of call it from a business standpoint, an incremental business plan, right? And it's not your standalone business plan as a seller, and it's not the standalone business plan of the buyer. People miss a lot the ability to reposition the combined entity. And we throw around the words like synergy, but a lot of the time it's can you take product and drive it through channels a lot faster? Can you open up a new route to market like an MSSP business that maybe an acquirer doesn't have? And then I think so there's really a whole analysis of an incremental business plan and what does the world re-rate the combined company as, right? And a lot of times in security, the big innovators need to buy, or the big companies have had a hard time delivering innovation. And I talk a lot about the cybersecurity industry in general, sort of tracking or approximating maybe pharmaceuticals or bio, where is the entirety of R&D and the entirety of innovation been sort of outsourced to a venture capital function and a joint venturing and partnering function? I don't think we're that far along, but I think it's further like that than most people think. Big tech and big enterprise tech traditionally has been able to deliver innovation from inside of it. Security has struggled to deliver, and a lot of it is, a lot of the resources get allocated towards integration engineering, it's difficult post-acquisitions for a lot of the big companies to innovate. And that's why we have so much capital going in, because it's the one place where innovation is being delivered into the big problem we all know is happening.
I mean, sorry to interrupt. The other thing is that the only industry that exists where there's an active foe on the other side trying to break everything you do is security. So the whole equation around innovation, I think, will always be somewhat different for cybersecurity than other spaces.
Let me add different things. I think, I give you a different viewpoint, because coming from an entrepreneur and being acquired 5 times, the number one thing is you want to focus on revenue and customers. One good acquisition is you want to be a market leader. The only way you can be market leader in cybersecurity space or any other space is you want to have enough customer revenue. If you are the number 1 player, you get good multiple. If you are number 2 or number 3 or 4, it falls down exponentially, right? So that's the number 1 I look for. If you are not a good revenue multiple and if you don't have a good customer base, then better have a people team, right? I mean, people acquisitions will be traditionally, again, where the location. I know the earlier panel talked about the location doesn't matter. Where I come from, if you're a product company, it's all Silicon Valley, baby. That's it. I mean, if you're outside of Silicon Valley and Seattle, you fall down in terms of what you get, right? If you're in Boston, New York, or even in Israel, it's not that same multiple you'll get, traditionally speaking. So I think the location of the people matters a lot going forward. Look at any large company like the cloud providers. They really want in Seattle or Bay Area all the product teams. So that's what I look for in those two.
Silicon Valley or your son. Eric, anything to add that you think makes a successful investment or M&A target?
Sure. I think Ken nailed it. I mean, we talk about sort of 2 dimensions when we go into big companies like Symantec or Pan or Fortinet, companies like that, Proofpoint, which has a very successful programmatic M&A program. Extinguish and extend, right? So you have an installed base. Do you need to put the fire out, right? Is there something that you're not doing, or is there FOMO? Is there something that your competitor did that you need to make a reaction to? And then extend, and looking at proven and provable opportunities.
Sure.
So we spend a lot of time on the finance side, really going through and down to like pricing and bundling, right? What is this going to sell in the channel? And if you can sell that story to one of these strategic acquirers, you can get a price that has nothing to do with the multiple. It has everything to do with the opportunity. And M&A is all about people. These aren't companies, these aren't products, these are people. And you need to find a sponsor, and you need to sell that vision. And a dirty little secret is, whatever you've done as an entrepreneur, whoever, you may be asked to reinvest up to 50% of your sweat equity into the combined entity and then earn that back over a couple-year period of time. And you'd only do that off of trust and vision, and you got to sell that story. You got to get a board to sign off on it.
Sure. I want to flip the question a bit and ask if there are any deal breakers or any things that you see as serious red flags from companies that are pitching themselves or out there in the cyberspace. What do you see as, aside from a headquarters in Boston maybe, red flags or deal breakers for you guys? Any thoughts on that, Muddu?
I mean, look, this is the age of cloud and machine learning, guys. If any company is doing only hardware, appliances, you're pretty much a dead person walking right now. I don't think many companies want to buy an appliance companies. Even any CISO, if he's buying an appliance company, he or she will be thrown out, losing his job. So I would not touch any appliance or hardware companies. And if you're a cybersecurity company, better make sure you don't get hacked. There are enough companies got hacked themselves, and they're shopping themselves. Nobody's going to touch you if you're already got hacked, right? I mean, the simple common sense, right?
Yeah.
And the third thing is, as I said, if you are not speaking the world of cloud, is going to be 50 billion. I mean, I see about security. Security is still old. To me, it's like a very old, stodgy market. There's no energy in security market. There's no AI, machine learning. Everything is like very old technologies there. Whereas cloud, people are running away, guys. I mean, look at between Amazon, Azure, and Google. They'll do 50 billion this year as a revenue-wise. Entire security market cap is maximum will be 10 billion, 15 billion. There's something is wrong in the security space. At least the good thing in the last 12 months is new companies went IPO. Right? So I think the consolidation has to happen. Nobody's buying big companies because they're all old, not growing. So the spring cleaning needs to happen in security market.
Any response to that, Eric?
Red flags, again, I go back to people. When I see that a founder wants to control a process, doesn't want to put a lot of people under the tent, what are you hiding, right? The truth will always out at M&A, right? You have a 30 to 60 day confirmatory due diligence process, and everything is going to come out. And so the quicker that you can get to the truth for a buyer and a seller, you can eliminate those false positives and hopefully have a great outcome for both sides.
Yeah, people's absolutely, and I think one of the things missed is a lot of sellers have a relationship with the buyer beforehand, and part of that, it's almost like a hiring process for the buyer to get comfortable with, this is going to be my new VP of tech or my founder and the GM of the division. The only other thing I think that isn't talked about a lot that I think is very real in M&A, and as you start to think about metrics, we already come out on today's panels, everybody talks about the valuation at the time of the deal, and I got 10x or 15x or this 100 million or this billion. I think what's maybe more important to a lot of acquirers, that sponsor owner, if you're talking about a big company, they don't really own the stock. It's a publicly traded stock. They don't really own, they're not writing a check per se. What they are going to own going forward is a combined P&L. And what I think does not get paid enough attention to from a seller's side in M&A is who is your sponsor and what does the next 2 years of the P&L on a combined basis look like, and what are they absorbing? They're taking career risk. The person who signs up and puts their name on your deal, again, a ton gets paid to the cash consideration because that's what we can see in a press release. A ton gets paid to the amount of stock or the amount of debt that was taken out, because those are the things that are easier to collect and see. But I think as important is the sort of impact on that company's P&L that you really probably can't see. And I think it's as important, if not more important, than the amount at the time of the deal.
Sure.
Yeah, I'd say there's a few things, some kind of prior to a deal and some in the due diligence period. So prior to, if you are kind of a completely virtualized company, we can't really figure out where anybody's sitting and kind of where your kind of core R&D centers are, or if those R&D centers are just places that we don't exist today. And because any big company is constantly going through site consolidation, and kind of the hidden power in any big company is the facilities guys. So it's all about kind of being able to efficiently do the acquisition. That's number one. Secondly, I think once you get into a diligence period, oftentimes, it's very rare where we're in a diligence period and we don't follow through with an acquisition, but when it's happened, it's been things where there's structural problems in the company themselves. I remember one example where a company had, with their initial big customer, had given them perpetual source code rights forever. That's a showstopper for us. So things like that, you can, and sometimes it's the cap table is so messed up in terms of the early company, and as it's gotten to the point where we're going to buy it, it causes a lot of concern as well. So I think structural issues, and this is where good venture investors can make a huge difference. If a company from the ground up is actually built in a way that makes it easy to work with, easy to acquire, that makes a big difference.
Right. I want to pull it back a bit. What do you see as the outlook for M&A in the cybersecurity space for the short term and the longer term? But what are we looking at right now, especially post-tax reform? There's a lot more cash sloshing around. What do you see? Maybe you can start with Ken on this one, or Eric.
I'm going to jump in.
Yeah, please. I'll disagree with what Eric says.
My business model is predicated upon this answer.
Right.
So we track every single deal in the space, every investment above $1 million, every M&A deal in cybersecurity. What the data will tell you is year to date, we're on pace to crest 200 transactions in cybersecurity for the first time. Last year we did about 178. The year before that, 173. Last year, $20 billion in aggregate deal value, which is kind of a shadow of some other sectors. But for us, that's pretty darn good.
That's good, yeah.
If you think about public market cap and this IPO market that we're in right now, it is critical. It's essential that we have a healthy equity market to have a robust M&A market. We need more market cap in cybersecurity, so root for those IPOs, invest in those companies. Carbon Black, Avast, Getting Out, SailPoint, Okta, Forescout, all these companies have, for the most part, have gotten out at or above the range and have performed pretty admirably after the IPO, and in some cases they've already gotten into secondaries. So that market cap is important. Right now we have a public market cap in aggregate in cybersecurity. These are pure play cybersecurity companies, so I'm not counting Cisco and Microsoft and IBM, which all have big cybersecurity businesses. But just pure play cybersecurity companies, there's 24 4 today that we track, and the aggregate market cap, I'm going to be off by like $5 billion, but is probably around 160, 170 right today. And in 2010, that was less than 50. It was just hard to get big deals done. There was just really no kind of flow in terms of the M&A market. So I think we're going to have a record-setting year in terms of number of transactions, and those swing states are, those big kind of public to private deals. So you see Barracuda and Gigamon, those kinds of deals. So we'll see what happens in those.
Muddu, anything to add?
Yeah, I may have to give you a different view. I think I do agree with Eric on a few things, but I think if you look at step back again, the largest market cap in cybersecurity is, let's say, Splunk or Palo Alto. It's like 15 billion,
Symantec's
16
the
billion.
biggest market.
Symantec, what is it, 15 billion? 18
There's an answer last week and an answer this week.
Yeah, I want to know this week. Like, none of them have exceeded $20 billion, right? If you look at it, it's like, and then you have all these companies. Good news is at least there are more IPOs in cybersecurity, right? You have Okta went IPO, you have Zscaler went IPO, so at least there's a new avenue than M&A. That's a positive thing. But these market caps are between 2 to 3 to 4 billion, so how much they can pay between 100, 200, 300 million dollars is very limited in terms of acquisition price. So if you look at what needs to happen in M&A, first of all, the large companies, I call them sick companies, they need to go away. I mean, you have so many network security companies to so many of the old companies, there's no consolidation in cybersecurity. The new babies that VCs are investing, for them to grow, the bigger companies needs to go away. That hasn't happened, right? I mean, somebody wrote a report, there are 10,000 companies in cybersecurity, and at least the old companies, about 50 to 100 old companies are still there. So unless the old companies die, the new companies are not going to be born.
I'm not sure if I like where this conversation is going. I'm going to jump in.
Right? And the news will change. I mean, my prediction is, like as John Chambers predicted at one point, I think when the dust settles 5 years from now, there will be 4 or 5 aircraft carriers in cybersecurity. Everybody else will be decimated. It won't be 100 aircraft carriers.
So this game has played out, I mean, there's cycles of this that have played out over the last 20 years. And so Symantec's done 2 very large-ish acquisitions in the last couple of years. Blue Coat was a $5.2 billion acquisition, give or take. LifeLock was a almost $2 billion acquisition. So we're able to deploy large amounts of capital at scale, which I think when you think about consolidation, when you think about kind of the ability to kind of, like we said, plug things in, drive additional value. Most small companies will never get the scale and go to market. And Israel, where we're also very focused as well, there's also been a lot of great technology companies that have never even really attempted to develop the go-to-market. They sell a little bit earlier. So I think the acquisition is always going to be about size and scale. There's technology tuck-ins. Those are important. There's some of these larger acquisitions. I think private equity is the big piece that's changed over the last 5 or 10 years. And we've done a bunch of deals where we've bought from private equity that have taken, obviously, companies private. They've cleaned them up. They've gone through a couple of iterations. And they're deploying large amounts of capital. We just sold our VeriSign certificate business to DigiCert last year for a good chunk of change. We actually have board seats as part of my portfolio on that in that company. So it's a very interesting, I think, new landscape to a certain extent, with private equity becoming much more active in cyber.
Yep. And then can I just so private equity, we have a relationship with KKR, and then private equity is sort of a new entrant in the room in security in the last 3 to 5 years. Exactly what you said, and it really stepped in at a time when companies couldn't get public. I think it's an interesting time right now because security companies, the IPO window's back open. So the balance historically has been in favor of the big acquirers being able to win, and the big acquirers, I used to work in corp dev at PeopleSoft, which was the client server version of Workday, if you've never heard of it. It's when you're doing corp dev work, they have good teams in there. They do buy, build, partner analysis. What happens in security is it's really hard to build it yourself. At the end of those analyses, when they're looking at it, there's whole new areas of IP, there's whole new areas of domain expertise, and they can't really get there themselves in time to market on build. And partner isn't ever quite adequate in the end. It's a good short-term plug. So they've had to buy companies to sort of plug in innovation gaps. If you look back, the balance has been in favor of the big acquirers for a long time, until about the last year or two, with private equity on the scene paying really nice multiples, and with companies being able to get public in security. That Muddu just went through a list of them, but I think there's 5 or 10 more coming in the next 18 months, we now have the sort of, the leverage is shifted back to the sellers to a degree. So I think we're at a very interesting time in the next, a couple of years.
But as a seller, you have to be very careful about selling to private equity versus a public company.
No, that's a different thing.
In terms of the experience you'll go through, because private equity companies have a library of best practices, a playbook that they'll apply to all their acquired companies, and
But if you're a founder, you still run your company. You're not working for that team. You're not
you
now
may lose a
reporting
significant chunk of your employees in the hollowing out process.
There's pros and cons to both approaches.
No, I think private equity, I do agree with Ken on that, which is, look, as an entrepreneur, CEO, I would never sell to private equity. It's like selling into like vulture capitalists, right? I mean, they'll never pay you a good multiple. They want to squeeze everything out of it. So your number one goal should be go IPO. If you can't go IPO, sell it to a high growth company. Like private equity is going to buy you things which are like a not growing company. They're going to change the management team. They're going to starve people, not giving them coffees and everything. They want the extra juice out of the company, dress it up, sell it back to Symantec or something. Right?
I think that's I think it's a very dated view of private equity, Muddu. I think if you look at the last couple years, and two deals I've been involved in, private equity has bid higher than the strategics in the last few security deals. I think that's new news. This isn't 2000 anymore in private equity.
Look at 2018, no entrepreneur in the valley will ever sell to private equity unless his hand is forced out.
Well, and I guess
Blue
you could
Cat
say
Networks, you look at Ping. So there's this new kind of venture to private equity arc that has been established. If these guys will pay.
And some companies done very well once they've
but
done.
you have to buy into the growth. And look, I was at Blackstone, or co-founded Blackstone Silicon Valley Advisory Office in 2008.
I think
the firm could not underwrite growth. Right?
Like as Ken talked about, if you have a large division that's not growing, you sell it to private equity. As an entrepreneur coming out of like high growth companies, you don't want to sell it to private equity. That's the last thing in your mind.
So maybe now you have some more options.
Yeah,
Maybe
more
you're
options,
more
yeah.
squeezed past few years, and now you've got more options on the table. You could go many different ways.
Absolutely, with IPOs.
Sure. So let's name some names. Are there any companies that you see as desirable takeover candidates, or potentially for someone who does something slightly different? Anything out there that you are eyeing? Muddu?
Absolutely. FireEye should be taken out. All you guys in the room, if you have a check, go buy FireEye. Sell it off. I mean, there are all these companies that should be taken out, like same thing, CrowdStrike, Cylance. I mean, look, number one in each player, anti-virus market should be taken out. The whole network security, given the appliance hardware is going to be consolidated, all those players will be gone. People are waiting for the right price to buy them. I mean, that market will be gone. Same thing like in the whole UBA space, people have happened. You recently lost Splunk bought Phantom, right, with SOAR category. The next number 2, number 3 will be gone in that space. So I think every space, number 1, number 2 will be picked up, and remaining guys, either they'll starve or they'll die. That's it.
Are there other companies or niches that you find particularly desirable out there?
Securing the public cloud is critical.
Go through your pipeline, Eric.
I know.
Who do you want to sell to?
Under non-disclosure agreements with all those companies.
No NDAs. It's an open market.
So it's a little bit of a tough question for
No,
me to
but,
answer, obviously, since we have an active strategy.
But the
Yeah.
source space that you mentioned Phantom. We see a backdraft in probably a handful of deals that have happened year to date. So that's one of them.
What do you mean by backdraft?
Backdraft meaning that as soon as the number one perceived 1 or 2 company gets the trades, there's going to be probably 2 or 3 more deals that are being evaluated. And in that space in particular, I don't think it's a secret. Everybody else is kind of looking at musical chairs in terms of buyers and sellers.
I mean, the one thing I'll say, which there's often discussion about this, is when you do M&A, is it ones where the company approaches you, a banker approaches you, or is it a company that you've developed a relationship with and are working with? And it's, for us, very heavily weighted towards, like we almost never do a deal if it just shows up. We have no relationship with the company, and a bank will say, hey, take a look at these guys. So it's really those companies that we're either have an ongoing dialogue with. Ideally, we've got some partnership on the ground with, and we're actually creating value together. Those are the acquisitions that are, and there's different strategies in terms of, like we said, size and space, but it's that whole ability to kind of create value together, and then M&A actually accelerates that versus kind of being this opportunistic thing.
Yeah, I would agree with that. I think there's the kind of, we call it the fork in the road process. You're going to go and maybe you get a preemptive term sheet for your Series B or your Series C. Maybe your competitor just sold. You're getting all kinds of inbound inquiries. You want somebody to talk to, right? These are matters of strategic importance. The board is asking you. you want to have a counselor by your side, you typically, call our firm to figure out if there's other homes for the business other than the folks that are calling you. But to Ken's point, yes, I'm a big proponent. Business development before corporate development. Always think about building your business, adding your customer base, adding value to your customers, and selling software. The number one thing that can sell security companies is selling software.
And I think from a seller's perspective, though, if you're, it's an interesting, the timing of when you sell. So we're involved with companies. I'm on the board of Cylance. We're involved in Darktrace. A few other companies that are, quality companies. When you have an innovation edge and you're winning in the marketplace, it's not the right time to sell per se. I mean, the timing of when you sell is a very critical sort of decision. And if you can take companies public, that's a very attractive alternative, frankly, to what most of the M&A markets are going to yield these days. M&A is sort of catching up and stabilizing a bit, but M&A, I would say, large corporate buyers have had an advantage because the IPO markets for security companies have been fairly closed until a year or two ago. I think with that reopening, the advent or the entry of private equity, we talked about there's a little more leverage and there's more options to companies. Companies that are winning, are growing, have an innovation edge, and it's probably not in time you're going to see M&A.
So as you have more option to pursue an IPO, maybe, or it becomes more feasible, like we'll see an opening up there, and you might not have to pursue M&A at all, actually.
3,000 cybersecurity companies, not 10,000. There's 3,000 cybersecurity companies out there. Until this last 12 months, we typically had 0, 1, or 2 IPO events in cybersecurity every year, right? Do the math, it's not hard. 150 M&A deals a year. Do the math, it's not hard. The backlog, if you take the number of IPOs, add it to the number of M&A deals, and divide by the number of companies out there, it's about 15 years of backlog that we have to get through to sell every company out there that's been invested in. It just ain't going to happen, quite frankly. 68% of all M&A deals in cybersecurity are below $100 million. You need to be like the Tony Gwynn of cybersecurity to win. You need to understand that these are about hitting, a double in the gap, right? And if you can do that and time that, you can win as an investor. And it's special situations. Cyber is all about such special situations. It's the most nuanced M&A market of all pockets of technology. What's nuanced is it's growing so goddamn fast. At the same time, there's tons of opportunity. And you have to really understand it. You have to have access, and not just access to those 24 public companies that I talked about, but it's the out-of-segment buyer that we find is most interesting. I'm getting calls by the big four. All of them are investing in cyber. KPMG, PwC, Accenture, product companies too, not just services companies. Defense, aerospace, obviously, they've been there for a long time now, kind of a love-hate affair with cybersecurity. But take a company like ADT, 143-year-old company. Everybody knows ADT. You can show it the little blue octagon to anybody, and they'll like, oh, that's ADT, right? Been protecting physical networks for 143 years. Done a pretty good job. They have 8 million customer billing relationships. 500,000 of those are with small businesses. If that company is going to be relevant for another 150 years, they better be protecting digital assets, not just physical assets. And so we're helping them get into that space. And so that add-a-segment buyer really moving into cybersecurity is something that I would say, if we have 24 public companies in cybersecurity actively buying smaller companies like Muddu, then we'll probably have 50 other companies, technology companies or industrial tech companies looking to get into the space.
But the thing we hear, I'm sorry, Ben.
Go ahead.
The thing that, in terms of customer conversations, like bring this back around to our large enterprise customers, for example, the thing that we've talked about for a long time strategically is big customers want a smaller number of vendors. They want to go from 70, 80, 100 security vendors down to kind of platforms with a much smaller number of vendors. Yeah. I think that's now real today. So we've actually, and if you think about it, what a big security deal looks like for a large security company selling to an enterprise, it used to be single-digit millions was a big deal. You now see kind of tens of millions of dollars deals happening quite often. That's about platforms. That's about integrating capabilities together. That'll drive a bunch of this M&A as well. It's the ability to do much bigger strategic relationships with the largest customers in the world.
And I think John Thompson, the former CEO, was famously quoted, "One throat to choke for the customers." That's what the security customers want, single throat to choke. No one got fired for buying IBM. He tried to sort of take it, and no one got fired for buying Symantec. The problem that happened is they bought a lot of companies, and they ran into the integration engineering challenge. What looks good on the slide, and it's not just Symantec. McAfee had the same strategy that Dave would tell you. Dave DeWalt earlier today, I've heard him give the speech. It was hard to integrate, and you said in the last 4 or 5 years, it's gotten easier to integrate companies and technologies that you buy. So maybe we can reduce now the number of vendors, but the dream of getting it down to 1 for customers, I think, is fiction. I think it'll sort of go from 80 to smaller number. Yeah. The second thing, I hear this question a lot, and I hear this in the industry a lot about, we have 3,000 private companies, and there's this big overhang. And I think that sounds like, oh, it's a dire situation. How do we square the circle with all of this? Yet at the same time, the threats are exploding. And I think you have to look also at the return on investment of the big companies in R&D, right? And there are, how much R&D is going on in the 25 public companies that we can get to know, $20 billion a year. It's not delivering for customers. If it was, there wouldn't be this much venture capital going to the space and this much venture capital and new innovation happening. The return on investment from the large companies has largely failed in the last 5 or 10 years. And that's why there are 3,000 small companies, because they're filling in a void in the marketplace.
I would disagree. Well, I agree, but I would disagree a little bit in the sense that any big company that's trying to innovate, big companies innovate all the time, but it's never going to be enough because there's operating expense constraints on every company in the world. So you can only ever fund so much activity. And balance sheet investments, which is what VCs do, startups convert balance sheet into innovation. Like they take it, they burn money, they don't make any profit, and eventually they'll build innovative products, hopefully, that then start to drive revenue.
I hate to cut us off short here, but I think we do have to wrap up. So any final thoughts from anyone before we?
Yeah, I'll close it out in a few things. I think the reason I talk about the historical, whether 3,000 or 8,000 will go, is they're all still focused on the old technologies. Like today on the panel also, we didn't touch much about cloud, DevOps, the automation of entire cybersecurity. Think about what's happening. In our lifetime, we are going to see a driverless cars. Why is security still talking about security admins and people? There is no level 5 automation security. So all the new age companies that are happening versus the rest of these 3,000 to 10,000 companies, there is totally apples and oranges. So the next 10 years, the security will be so different than what the companies have built. So buying these companies, integrating them is one thing to cleanse the market. The new age will be in the DevOps, security, machine learning, where you eliminate the human in the equation, the whole security automation. We didn't talk about it. Those companies are being formed now, and they will become the leaders. And I think 5 years from now, who will be the leader in security will be different than the current leaders are.
And it'll be a whole different landscape. Well,
Absolutely.
Thank you to all of our panelists, and I invite you guys to come up and ask questions afterwards. Thanks very much, guys.
Thank you.